So good afternoon, everyone. Good evening. Thanks for joining this session. We'll give it a couple of minutes for the rest to join. Bienvenido. Willkommen. What language do we have today, Stephen?
David, just a French. Maybe you can also. I know your.
I still got to work on the Portuguese, though. We still got to work on the Portuguese. But how was the vacation?
David, as you probably know, when you have young kids and you go on vacation, you know who goes on vacation and who's sort of like the servant, right? So it was a change of scenery for me, a vacation for my kids.
So Stephen has 4 daughters. He's a very smart and ambitious man. Okay, no, I know the feeling. I know the feeling. But as I keep saying, I'm a poor European. Like I don't have a nanny and a pool boy and a chauffeur and all the good things that you have.
David. No, but you're right. Yeah, when you get some of those, they help a bit during the holidays. But you're still the parent, right?
True. Very good. Okay, thanks everyone for joining. We'll start in about a minute or so. Let's give another minute for for more people to join.
And David, I'm also really, I mean, you're just talking to Eghosa earlier, and I know we're going to have him for the session. I mean, Eghosa, I really enjoyed your podcast, the one on sort of like valuations for venture capital and how to make things work, how to make the maths work with time. And that was really, really good. I got some inspiration from that and did a blog, sort of like borrowing a lot from that, speaking from an angel perspective. But I think it really solid advice for people just to think portfolio wise and to know that once you get one pay stack, it doesn't mean that everything is good.
Oh, thank you. No, I always run into people who take these things that I share very different ways. Some of them are very appreciative of it. Some of them think I want to spoil the show. I want to put sand in the food. I want, and I'm thinking, again, to each his or her own. I just, a lot of it is just being willing to share what I've seen, what I've done. And, I always tell people, look, some of us who came first, took a lot of bullets. So the next set of people don't take as many bullets. You're going to take them, there's no getting around that. That's for sure. But at least you can sort of, mitigate you can reduce the actual number of bullets that you take. Right. So, but, a lot of what we do in venture is always a long game. Right. So sometimes you teach a lesson and it takes people 8 years to learn the lesson. I've had people come to me who were like, man, I remember what you told me in 2014 and I dismissed it. And, and I'm like, oh, you were right. But I was like, that was 8 years ago. So it took you 8 years. Okay. It's pretty good. I told you then, so it wouldn't take you 8 years, but hey.
Okay, everyone. Yeah, I think we people might think we started already, but we're still sort of in the chit-chatting phase. Yes, but I think it's maybe a good time to get started. So thanks everyone for joining this session this evening. The masterclass where we're going to talk about ethics and values with a very special guest, Eghosa Omoigui. We'll introduce Eghosa in a moment. Also joined today by Stephen Gugu, who is, of course, one of the partners, co-facilitators in the African Angel Academy. And trying to stay in the background, as always, is Ayanda, who's helping us out from Cape Town with all the logistics, technicalities, and making sure that these programs run super smoothly. I also saw that Richard joined the conversation. So Richard, as you probably know, or joined the group. So Richard's here representing, obviously, Orange Corners, the sponsor, the partner in our program. So very good. Hi, Richard. So today we are going to speak about ethics and values. We have an agenda that will not. There we go. Yeah, so this is obviously sort of an agenda for the greater session. So we'll obviously have a bit of a presentation, a panel discussion, and Q&A. As always, we're trying to keep this conversation as informal as possible. So everyone at any time is very much invited to, ask questions, comment, raise your hand, drop questions or comments or thoughts in the chat function. That we want to make this as interactive as possible. A little bit of myself. Obviously, my name is David. Here representing the African Angel Academy. As some of you might know, I also do work for the European Investment Bank, a program called Boost Africa, which is a fund of fund. I do a little work for GIZ, an investment readiness program called SIZE. And then the investing I do myself nowadays is mainly via a angel collective called Rallycap Ventures. We used to be called Rallycap Ventures, but because of legalities, we had to change that name to Rallycap Ventures. It's a long story. We'll save for another day, but there's a lesson there about making sure you name your angel network or group collective in one go. Okay, very good. And then also on the list to join us today is Omoigui. Sorry, she is still in flight. So I hope she will join us a little later. But she had to change the flight from yesterday to today. So Omoigui might join us later. She's not here right now, as far as I can see. Also, very happy that Stephen is here to share his wisdom and co-moderate where needed. Okay, very good. So a few words about the masterclass itself. So I wanted to start with a conversation about why are we having this conversation? Why are we talking about ethics and values? Next to a conversation we've had before on valuation, on term sheets, on legalities, etc. Why are we speaking about ethics and values? A little bit about theory, some conversation about context, meaning that we're having this conversation in the context of early stage investing, of a startup ecosystem. Everyone in the room here is a business executive. People are founders themselves, bankers, lawyers, extensive business experience. But this specifically, here we specifically speak about angel investing and that context. So I think it's good to sort of zoom in there a little bit. We'll have a conversation with Eghosa, but also with everyone, of course. And then I hope we kind of end the session with action. So we'll go through a whole list of ethical dilemmas and challenges and problems, and then let's see if we can sort of come up with some actions how to try and manage those situations and those processes. And so why are we having this conversation? So top of the list is a number of recent incidents that also made us think about the relevance, the necessity to spend time talking about ethics and values. Recent incidents, by that I mean there's been a lot of noise around Flutter Wave recently, but also about other companies with in the case of Flutter Wave, particularly behavior by senior management, CEO, misbehaving, being abusive, sexual misconduct, and again, your allegations, right? But there has been talk about the incorrect use of employment stock options. There's a whole range, a whole list of things that are not going maybe as we all thought they were going, or maybe that we think they should be going. A second here, shared ownership or shared responsibility. Obviously, when you invest in a publicly quoted company and you buy shares of Microsoft or Apple, then you're far away from the company, and there's no responsibility really attributable to you, even though you own 0.00001% of the company. And that might not be the case when you invest in as an angel investor. You're probably much closer to the company, much closer to the founders, and you also probably have a responsibility in terms of how the company acts. And you might be called on also to sort of justify the actions from the company. So you're much closer to the action, if you will. And as an angel investor, there's a fair chance you will find yourself also playing a mentor role. So, your moral compass, your understanding of what is right and wrong will also influence the behavior, or possibly influence the behavior and the thinking and the actions of a founder team. You can find yourself on a board, right, that comes with certain responsibilities, where again, ethics, values can come into play. You can find yourself in situations where you're managing conflict, for example, between co-founders, not uncommon, where again, your own sort of understanding of what is right and wrong will play a role. There can be misalignment of interest. So here, I mean, misalignment between, for example, the founder and you as an investor. The founder might want to run a company for the next 20 years. You, an investor, are looking for an exit in 5 years. There's misalignment. There's situations where, again, there's a conversation about what is right and wrong. Last on the list here is, as an investor, you will probably have access to sensitive data. You need to understand what that means, and also what you can or maybe cannot do. So there's a whole range of reasons why ethics and values, we believe, is an important conversation, and why I want to spend time when discussing this. There we go. A little bit on just one slide on some definitions. So ethics obviously is the principles that govern behavior, your actions, values, your value set, your beliefs, what is right and wrong, moral compass, or your ability to judge what is right and wrong. I didn't want to spend too much time on it, but I thought it was good to sort of pull up these definitions. And this actually, I thought it was fun. So I actually remember from my own college days, this first sort of ethics, this test from an ethics class, where there's sort of this theoretical conversation, but then to actually make it come to life, right? So this first test here, if you would find yourself having to explain a decision, a situation, for national television, or in a newspaper, on the front page of a newspaper, would you feel comfortable doing so, or would you feel uncomfortable because somehow, somewhere you made a decision that was maybe not, that didn't feel right? Second test here is, what if everybody did this? So, if the whole world would act in a certain, questionable way, is that the world you want to live in? The third one, a parent test. So it's all the same thinking, but I mean, these are like mind exercises to, in a way, think about some of the more, questions that relate to ethics and values. And then, so something about this startup ecosystem, and why this, obviously there's a lot of similarities across the business world as you invest in real estate or companies, but there's also maybe something that's quite different in the world of startup ecosystem. So one is that this can be disruptive, meaning that possibly there are companies that are trying to challenge the status quo, that they're also challenging maybe the boundaries of the law, if you will. If you think about companies like Uber or Airbnb, they do things differently. They might find themselves in disputes about labor laws, about if there's an employee, yes or no. It also can create an atmosphere where maybe Uber is actually willing to pay certain fines because they have either enough money in the bank, or that's the way they want to, right? So the fact that this is disruptive means that some questions might come up that are different, that you don't expect it, that you don't know of. Second, uncharted territory. It's a little bit of the same, right? I mean, we don't know where cryptocurrency developments and cryptocurrency is going to take us, or Web3, et cetera. So you might be investing in a company where you simply don't know what it will look like next year, and what kind of situations that will poses for you as well. So here you might be dealing with young, experienced, first-time managers who simply have less experience in running companies, hiring people, firing people. For this, it can be a pressure cooker, right? These companies might only have money in the bank to pay salary for the next 6 months. It creates pressure. It creates sometimes unhealthy pressure. 5, there is, occasionally or often or sometimes there's a sort of a fake it till you make it atmosphere, right? We're investing into companies where the value will be created in the future. So there's something there about selling a dream, and when where fiction and non-fiction can kind of blur, if you will. There's a situation of exponential growth. Sometimes these companies grow so fast, which poses its own sort of set of challenges in terms of recruiting the right staff, managing companies, etc. There can be a situation of a power imbalance, right? I mean, usually investors on one side of the room hold certain power to the founder, which are in desperate need in that situation, in a certain situation for funding, etc. And that can be an unhealthy power balance. And then investing in general is very much trust-based, and especially in the context of early stage investing or startup investing or angel investing, because there is still so little, accountable numbers or figures to work with. A lot of it's based on co-investments where, there's a lot of trust between different investors. So there's a number of things that I think are relevant to sort of acknowledge as we talk about ethics and values in the context of angel investing or the context of operating in a startup ecosystem. Now, that much for the sort of hopefully but a bit of setting the scene. And now I want to sort of properly bring Eghosa into the conversation. Eghosa, maybe it's easiest just to invite you to say a little about your background, your experience, and what you do as an investor, if you will.
Sure. Thanks so much for inviting me. I always love to collaborate and share some of the insights that we've built over the years. So I run EchoVC. We're a seed, early stage, early growth platform. We've been investing in African focused companies since officially 2014. We run multiple sort of sub platforms. We run seed, we run early stage, and we run sort of early growth. Before that, I was at Intel Capital for just under 10 years, investing in markets, across the US, Asia. The only market I haven't invested in so far might be Antarctica, and then certainly the Arctic. So yeah, so other than that, I think I've pretty much invested in every other market out there. And I appreciate coming. We're based in Lagos and in Nairobi and in London, and we've invested roughly under $50 million over the years. And so we've seen a lot. And here's the other thing that's sort of a little weird part about my background. When I was at Intel Capital, in addition to doing investing, I was also a lawyer. And so I did venture, I did M&A, but most importantly, I did bankruptcy and restructuring. And so, so my experience spans pretty much everything from seed to growth to death and to rebirth. And so what happens, I think, when you have that kind of sightline is that you see a lot of what I like to call character at rest and character in motion. So looking forward to talking about that today.
Very good. Thanks, Eghosa, and thanks again for joining us today. So, I mean, personally, I'm super excited for having Eghosa here. Maybe as a further introduction, the startup ecosystem, the early stage investing is not enormous, it's not huge. And so I've had the pleasure of knowing Eghosa for a number of years already. And I think everyone across the ecosystem recognizes Eghosa as, probably one of the smartest investors, but also someone who really is recognized for sort of, giving back to the community, but also, being very, very, very smart and educated, and sort of, I guess, being a mix of really sort of deep knowledge of simply technicalities on investing, combined with a certain sort of, Nigerian street smartness. I don't know if that's the right way to put it, but there's something there. So long story short, I'm super excited for having you here, and thanks again for joining us. So I want to start the actual conversation with a couple of polls, actually, to see if we can sort of, as a bit of an icebreaker. So Ayanda is going to help me out here. But I wanted to kind of pose a couple of sort of questions or present a couple of situations to the audience, and then get a sense of, you know, what is your reaction to this before we start sort of you know, diving deeper into this with Eghosa. So this first poll, and I guess Ayanda will pull up the actual poll in a second so everyone can, here we go. So the actual poll here is, you know, a discussion which is quite relevant in this day and age, is that there are investors who you know, will simply not take a board seat because it's so busy, but also because taking a board seat comes with liabilities and you got to deal with it, it's a headache, etc. So, you know, I'd rather take a board advisory role than a board observer role than an actual board seat. Now, the question here is that you know, is that perfectly fine? Is there something about, is it shying away from responsibilities, or it really depends on the situation? So the polls numbers are coming in. So, you know, people are still playing it pretty safe with opting for the third option, depends on the situation. And we have a perfect score, the perfect alignment between sort of answer number 1 and 2, right? It's understandable or it's shying away from responsibility. Eghosa, any sort of, you know, initial comments here?
So, you know, it's, you know, I think one of the things that I've observed across the course of my career is how often people misunderstand and underestimate the responsibility that comes with a board seat. I see a lot of people think that it's a sign of importance to the company. I see a lot of people who think that it's a sign of importance of themselves. But you know, it is a very important decision, and I think a lot of people tend to not really think through all the dynamics of what it means. I think that's the interesting when I look at your poll results. I think that is actually the correct answer. It depends on the situation.
Yes, no, I agree. Okay, let's take another one. See what happens. Let's take another one. Easy one. So promoting the product or a service of a portfolio company without disclosing that you have invested in the company. I mean, you know, it happens to everyone, right? I mean, I just happen to like, you know, what the company does. So I got one on Twitter and Facebook, and I shared it with the world, and I have 100,000 followers. So yeah, some people might take notice, but is that nothing wrong with it? Or you gotta be, you know, you got to be a little bit more conscious about the fact that you have a vested interest? Where do we go here? Okay, so this is more, people are more outspoken here. People are pretty outspoken that it doesn't feel right. Although, you know, how many words can you put in a tweet nowadays? But I mean, it still feels that if you really have vested interest, then you should disclose it. Eghosa, what do you think?
Tricky. This one's very tricky. You know, in my view is, if you're an institutional investor and you're seeking more and more entrepreneurs to pitch their opportunities to you, it actually becomes very crucial that the entrepreneurs know if you're potentially investing in a competitive company. I think for angels, it's a little bit different, right? Because, you know, for them, you know, sure, they will shield their investments. And, you know, I think, look, you don't necessarily have to accompany it with oh, I'm an investor. If you do, that's great. It's good disclosure and it's good hygiene. But I also feel that if it's really different if someone says, hey, are you an investor in this company? And then you lie about it, right? Sure. But I do see a lot of people who pitch, you know, especially tech startups on Twitter. And I'm like, you know, not once have you ever told them that, you know, told people that you're actually an investor in this, you know, and it's disruptive because, you know, at the end of the day, people are coming to you looking for advice, and, you know, they might be looking for advice for things that may be potentially competitive. And, you know, and I don't think a lot of people know this. So So it gets tricky if you're a very active investor. I think it's important. If you're sort of a somewhat passive, now and then investor, it's neither here nor there.
Okay, Stephen raised his hand. Stephen?
Yeah, thank you, David. I was going to take you back to the previous poll for just a second, just to hear your thoughts and those of Eghosa. I find that there's a number of startups that also almost they don't want to have board members at the beginning, because it's just, for them, it's an extra layer of headache when they want to do things. There's someone who has to sign a document, there's someone who has to move things and so forth. And so I guess there's also this balance of, at what point do you then say, okay, now we need to put in the structures, we need to have actual board members. Like I remember hearing this chat from a president from Paystack, from what's his name from Paystack? Shola, yeah. And you're saying sort of the first couple of years, they would just sort of like just sign sales and people would just sort of like, send in the money and they would just sort of like run things. And these were like really huge amounts of money. And I was very fascinated that investors trusted at that level. But then also he pointed out the fact that helped them to move really fast, where they didn't have to, seek a lot of approvals from the board and everything, and they just kept it moving. So I don't know, what's your thoughts on that?
I think, first of all, you're absolutely right. We've had deals we're leading where the founders are like, oh no, we're not adding any board seats, we're not adding anybody, right? And that was also because it became, quite common in the Valley, right? That, these boards, everybody sort of say, oh, board seats are super important, just like the pro rata rights. You can't just give them out to everybody and this and that. And I've also heard founders say, oh, because we didn't have a board, we could move faster. And I'm thinking, we have portfolio companies that are moving faster than anybody knows, and they have a board. So, for every data point you bring, I have a counter to it, right? And what I've also find is that, like I said, going about not just minimizing liability as an investor, but it's also about the responsibility and the amount of time that you're putting into this company as a director. That is very important, right? I don't mess around with my director seats, right? And what I also have found is that if you're building good relationships with these founders, right, they have the comfort and the willingness and vulnerability to call you at any time of the day to discuss any topic, right? And and a lot of it is just about that, right? It's do I have these investors who are really committed to my success versus me just being a point in an index of investments, right? So it is a 50-50 thing, right? For every, I remember hearing that from another, sort of African unicorn. It's like, hey, we didn't have a board, and so we're really, we're able to move very fast. And I'm thinking, you didn't have a good board. You didn't have the right board, right? Because a board is not going to hold you back. It's not a retardant to execution and traction, right? Like I always tell people as well, one of the things, because of my weird sort of non-linear background, and I talked about it at the beginning about also sort of being able to do work, with restructuring and shutting down companies and restarting them. I have a very different sight line on risk. And so you can sit down and just be executing, and I'm the guy who's going to be like, here's what's going to happen to you, right? And 9 times out of 10, that's what happens to you, right? It has nothing to do with your execution, it has nothing to do with your traction, it has nothing to do with your being able to recruit talent or to raise money. It is about all of the things that you can bring as a value-added investor. A lot of people have these trite, examples of what that means. And sometimes your best value add is getting out of the way. And sometimes your best value add is just identifying risk before the founder sees it. Because again, founders are very, they have their blinders on. Whereas, a good investor is more like a periscope. You can do 360-degree views. So, but again, going back to this point, this board seat thing is important, right? It's not casual. People got casual. And you've got to get back to that, which is, this is a very important responsibility. There are fiduciary obligations to it. And here's the other element about liability as an investor. And, I think David's probably has seen some chats on this. Because a lot of people were getting to deals being founder friendly. In other words, I got to be buddy. I can't criticize the founder, even constructively. I can't do this, I can't do that, right? What then happens is that everybody forgets their roles. And when you're not a director, you don't really have that fiduciary obligation, because once you bring it on, once you turn it on, the fiduciary obligation is not to your buddy, the founder, it is to the company and its shareholders, right? Which would include the founder, the management team, and employees. So all of a sudden, what you're willing to do, with respect to the founder is very different. We'll talk about it, but I've fired founder CEOs before. And, I'm very open about it. I've done it. I'm not the first investor to do it. I won't be the last. I mean, there's some data in the ecosystem that suggests that Sequoia does that to 2/3 of their CEOs to replace them, right? And, and you can be like, whoa, that's wild. And then you now look at them at the very top of the VC heap globally for returns. And you're thinking, is that causation or is that correlation? I don't know, right? But a lot of this is just about being able to take your responsibilities very seriously.
Very good, very good. Thanks. I have one last poll. Let's see. Here we go. This one takes a bit of reading, but effectively, it's a situation where less experienced investors, more angel investors can be taken advantage of because they might not be as familiar with the situation. And then the question is, if you play with the big boys, then you got to do your homework. You got to understand. You gotta. This is the best way to learn it. So you lose, you win some, you lose some, and of course you can argue that, come on, this is not to be the way how you treat people. There's even though you might not breaking any laws, etc. Those pro rata rights are not in there for nothing. So the poll here, so just plain, majority says just plain wrong, although a fair amount of people are giving it could be argued both ways. Only 2 people right now have say, you play with fire, you get burned. Eghosa?
So this one's a tough one, right? And it goes back to Stephen's original, I think when we're doing the chit chat before the class started. So this whole issue of pro rata rights is fascinating, particularly for angels, right? I'm not a big fan of angels doing pro rata investments, follow-ons. Just because their portfolio construction is different from funds, right? So you're doing a follow-on into what will be a more expensive company. Not necessarily, sure, maybe that company, is able to turn around that investment around. But is that the best use of your capital when you already have exposure to the company? Right. So there's that. It's a separate question. But the more important question I think that's here is you have rights that are contractual, and then a VC comes in and has a term sheet and says, hey, I've seen where they just tell you, hey, you have pro rata rights, but I'm sorry, we can't give them to you. In other words, we're acknowledging that you have the rights. I'm just also telling you that you can't exercise them, right? So there's that part of it, right? Which is, is it's ugly. It's a communication problem, right? But it is ugly. And so is that right from a moral perspective? Probably not. It's bad form. If the founder is getting pushed to get this VC in, and the VC is demanding ownership and this and that, it puts the founder in a very tough position, because you sort of have to think about the founder and their responsibility to make sure they keep the lights on, right? Get the capital to execute, to preserve your initial angel investment, right? And so there is that. So it is. I think the key takeaway is that it's an ick situation to be in. and you know, and trying to manage multiple angels and a whole bunch of things. And you know, it's a classic. You know, you see people, they make money, then they make new friends, and all of a sudden they forget their old friends, you know, who came through when they really didn't matter. So I can see why both, you know, parties can sort of feel very, very burned about it. But it is, you know, it's not just necessarily about breaking laws. It is about just being able to communicate the dilemma these founders find themselves in and why this is going to be the case. And, you know, and then you're going to go back and, you know, and figure it out. But I'll give you one example where it was a VC to VC problem, because that involved me. So I was coming in to do a deal, very well-known deal. And one of the existing investor, you know, very well-known, you know, VC, you know, top 5. We're like, okay, great, we have pro rata. And the founder was like, don't know about this pro rata, right? And the founder went back to the VC and said, don't know about this pro rata. We're like, oh, no. We're like, well, because he also wants to do the whole round, right? And here's the problem. See, we already have your money, right? And we already have all the insights and all of the support and so on and so forth. So incrementally, we're not going to get anything extra, right? Whereas this new investor is bringing in a whole new set of vistas, new markets, new opportunities, new partners, and you know, and this is sort of their check size, right? So it was a very interesting back and forth about it. The founder eventually got his way. The VC was not happy, you know, and I understood that because you know, it's all question about model returns. But I could just say that this stuff happens not just to angels, it happens to VCs, right? And in the end, it's really about what the founder communicates and how they do that. But there will usually be feelings hurt. But you know, like I always say, when there's a distribution, all the hurt feelings can go away.
Thanks, Eghosa. But it's. I mean, I guess it's good to. I guess with all these questions, when you kind of, you know, dive into it, there's more layers of, I mean, complexity or so just automatically. You know, making use of your pro rata might not actually be in the best interest of the founder of the company, etc. It might, so your interest of an investor might not always be aligned here with the best interest of the company. Okay, very good. So 3 sort of polls also to break the ice a little bit. Now I want to sort of do a bit of an experiment. I've been thinking about how best to structure a conversation around ethics and values. You can look at it from, you know, the role of the founder and the investor and the board, the governance, etc. But the experiment is that I try to look at Eghosa's tweets, and I tried to find some of his more recent tweets that sort of I thought had relevance to this conversation. So it's about governance, it's about misbehaving founders, it's about etc. And I'm going to put Eghosa on the spot a little bit. I'll put different tweets sort of on the screen, and of course, I mean, the experiment is a little bit that, you know, a tweet in its own doesn't mean anything. So we'll ask Eghosa to kind of, you know, give us the context, the situation, and we'll try and treat these as sort of mini case studies. So I thought it would be, you know, the best approach to try and make this conversation as tangible, as real life as possible. So we're going to talk about real situations. And let's see if this works. I think it's going to be fun, but yeah, it's like I said, it's an experiment. Okay, very good. Okay, let's see. This takes a bit of reading. So this obviously talks about ecosystem and things that happen. In this case, specifically in the context of, I think it was Africa, maybe even Nigeria, but. I don't know if I'm going to guess that you know the background, what this conversation was about. Yeah. Can you just, for starters, maybe just give us a bit of background and then sort of zoom in on, you know, what actually is happening here and what made you also sort of speak out about this, and where does this sort of hit your moral compass?
So this is actually the original, the root source of this. A couple of different things. One was that there was a there was the whole, of course, these are all Nigerian startups. It's not exclusive to Nigerian startups, but they became sort of the example. So there was the issue with a company called Bento, CEO who I know, and Tech Bar wrote this thing about him being a horrible boss and the like. And then right after that, there was the Flutterwave issue with Clara, and so there was a Twitter Spaces thing that about horrible bosses and ecosystems. And then I just called him to listen to this because it's always interesting to hear what people are, how people feel, right, versus what you think. And there's a lot of stuff that went on in that Twitter Spaces. But I've been in the market a long time, and I don't say very much, but I spend a lot of my time observing. And people, I think, would be better served just to keep their eyes and ears open, because you pick up a lot of stuff. And so one of the backdrop to that was that I now made a comment on this Twitter Spaces about my not understanding why we were putting all these founders on pedestals that they had not earned the right to be on. And this just became this complete clusterfuck of just people going, oh my gosh, you're dumping on founders, you're this, you're that, da 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 da. Everybody forgetting that even as a I'm a founder of my own firm. Like, I'm also part of that crazy sort of group. But then I now went ahead to talk, a little bit, and I shared a much longer thread. Two of them. One was sort of the issues around culture and how to think about culture in companies, and then the other thing was just a rant about, just all the stuff that was wrong that I was seeing. And I wrote all of that, right? And then literally within the same week, Sequoia now writes an entire, blog post about similar things in India, right? And I thought it was funny because, people were sending me the Sequoia thing going, did they copy it from you or did you write this for them? I was like, no, I have no idea they were going to write it. But, that was sort of a lot of that. And so you can see sort of where they're copied on this screen. And I pointed out that, hey, Sequoia is sort of doing this, complaining about this stuff and, what you need to do. And so, this founder who's in LA was an interesting view, right? So he's I think he's Indian, but he's in LA, and he talks about this scarcity mindset and let's just go out there and just take our own money and take our own share, which was fascinating. But I was like, yeah, but we know this, right? If you've done cross-border investing, you get it, right? But this stuff shows up more in more fragile ecosystems. But my biggest concern was it had now become sort of like infrastructure. Like everybody was like, ooh, let's just go out there, create some companies, package this stuff, go raise some money, have no plans of building any kind of meaningful company anyway. But hey, to fund a lifestyle will make 150, 200 grand per year in USD, live up the life, right? But that's pretty much it. Because there's so much capital, we should go take our own share. And I think my point here was, a lot of these founders are just thinking this is free money. And my point is, no, I don't talk about how hard it was to raise and some of the stuff we've had to deal with across, along the way, but I'm not playing with you. I'm not here to sit down and encourage that nonsense. But that was sort of the backdrop, to this.
Very good, thank you. And I just want to invite everyone in the audience that, I can imagine that not everything will be maybe, as some of these tweets, of course, are very specific to a certain situation. If it is not clear, just let us know and we'll elaborate. Or if there's any questions or comments, other experience you want to share, just drop them in the chat or please raise your hand.
So I want to add one more thing, David, because
yeah,
Sequoia is copied on this, right? And I mentioned this about how there's some chatter in the ecosystem that Sequoia sort of replaces up to 2/3 of their founders, right? And and you talk to insiders and they're like, yeah, we've heard some anywhere between 60% and 2/3, right? Anyway, it's over half, right? And so you're thinking, that's really interesting. But one of the reasons why I've admired Sequoia is that a lot of the money they deploy comes from the GPs. And so you now start to ask yourself, so is that the same behavior you see when you're investing your own money versus other people's money? Is it that you take it more seriously? I don't know. So again, correlation is not causation and vice versa, but you start to wonder that, look, if you're not performing, and that's just stuff that's happening because you're not performing. Of course, if you're now trying to sort of cheat the investor or cut corners of the unethical, that's a very different thing. You're gone, right? But it's an interesting sort of insight into that, because Sequoia was sort of included in this as well.
Very good. Let's take another one. See what here. So this is this was about I guess communication, and about maybe also how hard it, or why the behavior of the perceived behavior by investors and VCs to be minimal in their communication, and you kind of push back saying, well, listen, there's actually reasons why investors are why they behave in a certain way. So maybe you wanted to sort of elaborate there.
Yeah, so there's a nested tweet underneath this, and it's kind of interesting because it started off from VC. I know she was talking about how founders can just be so insulting. They do this, they do that, and I was like, oh man, this just brings back memories, and I decided to go back into my inbox to share, a redacted, I sent feedback to a founder, and it's embedded inside this tweet somewhere, and I just redacted all the names, but I sent the actual feedback, right? And I didn't hear back from the founder. I am in a public gathering, and this founder comes up to me and starts to yell at me and says, I'm going to regret not investing, and how dare I think right in public. And I'm just thinking, what just went on? But years later, when founders complain, oh, they never give you feedback, like you were never there, right? I come away from an interaction, and David, it's kind of a shame, because what this audience really deserved to see is the actual feedback I gave, because it's in there somewhere. And everybody's like, oh wow, that could not have been what you. I was like, no, that's literally what I said. I just copied it from the email. And I was like, we like you, but it's not a good fit for us right now, the way we're thinking about, financial services, but we think you're a remarkable founder. Let us know how we can stay helpful. And that was the email that got me the tirade.
Sure.
Right. And
so I know Ayanda in the background right now is digging up that tweet. And I know exactly, I've read the tweet. It's a very professional email. You're just in a very professional and polite way, giving feedback to the founder why you're sort of why it's not a perfect match. There's nothing wrong with that message, but maybe it is also here. It is also about the power balance that, as a founder, maybe less today than a year ago, but you will find yourself getting no's from so many investors, or they don't pick up the phone, or they just they don't reply properly, or whatever, right? Is there that power imbalance, and therefore do you need to be extra sensitive also in your dealings with founders, because it can be hard to fundraise.
Here's the funny thing. I love the fact that people always talk about founders as if VCs are not founders. They talk about founders as if they're the only ones that get no's. I get no's every day. Every day. I get no's, where once in a while, I got a yes from super well-known investor who was like, Eghosa, I don't know why you're not managing $1 billion. Like, you're one of the best investors I know. So founders still the same thing. I'm like, man, I'm sitting on the greatest thing in the world and no one gets it. I mean, there's that, right? So we all get it, right? I think a lot of it though is, you know, and you know, to be honest, with that founder, I was like, maybe that founder just had a really bad day, right? Because I am always sort of trying to figure out, okay, there could have been a reason for this behavior and the like. But there's also the outcome of the behavior, which is I become completely uninterested in sharing any kind of genuine, legitimate feedback because I'm like, I get no prizes for it, right? And and I also sent out another tweet, which was sort of interesting, about someone who was like, here's how to deliver constructive feedback to your teams, right? And there's something, you're right, at least there was a power imbalance. I think that went away, and then maybe sort of, at the end of the day, this thing is just a pendulum. It just swings from one side to another, depending on the market and the time. But the real thing is, a VC doesn't actually know how good you are as a founder at accepting constructive feedback. There's no sense of it. I'm blind to it. So then I'm like, then I have to also be I have to behave in a self-interested way, which is, I may pass on this thing now and the thing starts to blow, then I want to kind of come back and try to invest in it, right? I can't antagonize this person by telling them a firm no. So we'll just kind of ghost the no and just kind of like keep it amorphous and whatever it is, right? But, again, it's optionality. VCs are sort of trying to preserve optionality here. And a lot of founders, particularly in nascent ecosystems, take no's very personal, right? And I'm just like, it should not be that way.
Sure.
It should never be that way. But, again, it's like I said, it's a maturity continuum here. So.
Sure. Yeah, but also, like you said, I mean, like, a no today might not be a no a year from now. Like, so there's that maybe sometimes as an investor, people want to make sure that the door is open, and then finding the right words of saying no now, but still wanting to keep the dialogue is maybe actually quite hard for
David,
people, or they don't think,
we got a no in 2017 from a large fund, and they show up last month going, hey, so what's going on? We're interested. We now have capital. 5 years, David. What am I supposed to do? Get pissed and go, I can't believe you missed out on all of that.
No.
I'm like, yeah, we're open. We'll have things to talk about. But those no's, a no to a yes can take literally, like I'm telling you, it can take 5 years. Right? But I mean, the founders are all looking for, things to sort of keep, driving them forward. It's funny, Michael Jordan people always used to warn, journalists, don't ever print anything that he's going to paste on his locker room door and use as motivation. Like, don't ever criticize it, because whatever team he's playing after that criticism gets published, he's going to see his red eyes, right? So some people just use these things as motivation and whatever, then that's fine. But it is kind of important, even in these ecosystems as we're all building, that you can say no's and whatever it is. And, it's kind of interesting because there are almost no no's that I regret.
Okay, very good. Let's take another one. Take a bit of reading here. Yeah, so this is I mean, a case, I guess, where you actually, as an investor, came across wrongdoings. So again, from that ethical, that values point of view, I mean, what was your reaction? What was the action you took? Because I mean, it could be that while addressing the issue, that might be had maybe not an immediate good effect on the company or so, right? I mean, you were so what happened here? Talk us through kind of what's the situation.
So I've had some mad experiences, mad, just completely mad. And because this is a masterclass on whatever, I'll give a little bit more. So this particular issue, the financial misdeeds, came from a co-founder. So I didn't talk about it in the thread, but I would share it here. It came from a co-founder. So it wasn't just some random person in the company, right? And what was fascinating was the founder comes and says, one co-founder comes and says, "Oh, there's a problem here, da 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 da," and we're like, "Okay, let's figure this stuff out. What's happening here?" And we do some digging, and we look at some of the financials and whatever it is. We're cross-referencing that with bank statements and the like. We're like, okay, there's a problem here, right? And so, and this was essentially what is well known as the over-invoicing problem, right? Which is something is 10 million and then you invoice it for 15, right? And then the difference comes back to, gets shared on the back end somewhere, right? And we were like, oh, great. And this was actually, I hate to say this, but it wasn't really fun, but it was great to sort of watch instincts get validated, right? We went through a process, went to the suppliers, actually used people to go get, actual invoices, so we did all the sort of investigation work to make sure that, we then validated that, look, there was over invoicing here. And eventually we were able to look at one of the suppliers, and he was like, he was just like, I'm just trying to sell here. I was selling this, I was told to put that, I sold what I sold, I got my money, they asked me to send the money to this other account, and so you get this very interesting thing where even one of the, I wouldn't necessarily call them conspirators, is just saying it wasn't really my fault, but I was told to do X, Y, and Z, which is, I think, is a cop-out as well, because you're essentially saying you're, trying to sort of huddle with the same folks. But once we found it, we documented it, wrote a report, documented it, and then called the co-founder in. We had the letter of termination, everything. And I did it face-to-face. I didn't do it on the phone, didn't do a letter, I did it face-to-face. And so when I talk about the difficult things and doing the hard things, not the, oh, let me be founder friendly and so on and so forth. I could easily have said, hey, we'll talk to them, let's go have a conversation. But no, because this is fundamental to the startup, right? You're stealing money. We can sit down here and call it financial misdeeds, but it's just theft. That's all it is, right? And we're just not going to have it, right? And so what you then ask yourself as an investor is, what are you going to turn a blind eye to? And I use this concept to, a lot, as we talk about these types of things called willful blindness. Like you see it, you know what it is, but you close your eyes. Because you're like, well, I don't want, or I don't want to jeopardize it around. Or there's a US investor that's going to mock me up and then sell, I can sell into the secondary. So let me pretend there's no theft. Let me this and that. And here's the interesting thing about one of these examples. I'm being very transparent here because I think it's very important to, take the lessons we've learned and share them. We had an example where there was some nonsense that was going on in the company, and there was a US investor that was going to come in. And it was a very difficult situation to be in because we could have lied and said everything is fine, and an investor will come in. But then guess who gets the responsibility after they discover this? It won't be the African founder who probably didn't really know what he was doing. It'll be this guy who you should have expected would know what he's doing because he's a US VC. So then it's not a question of, oh, you were part of this fraud. And so no one sort of thinks about the burden that falls on the investor, especially the sort of primary or lead investor in these kinds of situations. And so you're always trying to sort of navigate this. But again, like I always say, 280 characters won't let us be great, right? So you can't sit out here and give context to some of these tweets, right? But you know, we've seen this stuff before. There's another one, I think it's on this thread, where we discovered that our founder CEO was using our money to buy cocaine. His dealer was delivering cocaine to the office. Right? He had two of his girlfriends on the payroll. And by the way, this was the US, by the way, this is not Nigeria, because we were like, oh, that's a Nigerian thing. But I was like, no, this is the US. Right? And we had to do the whole thing, do the investigation, this and that. And then, you know, I fired him. Again, same process. You're across from me from the table. Because I've always sort of been a big believer that if I'm going to take you out, I'm going to take you out between your eyes, and you need to be looking at me, so I'm the last person you look at before I do that. Because otherwise, what's the point? Right? And so it comes back to being a serious custodian of capital, right? And you know, the whole thing about character and integrity. And I want to share a story that happened the last couple of weeks, because we don't see these things when we're sort of doing our hustle in the market and so on and so forth. I'm at a dinner in New York, a bunch of very important people there. And I'm talking about very important. And, they kind of, they like to do angel investing, and, some of them like Africa and so on and so forth and da. So they kind of keep tabs of what's going on. Based on sort of what they do for a living, you're kind of surprised. They're like, where's the African link? There's probably some child that went to Peace Corps in Africa and this and that. There's always some connection. So someone looks at me and goes, hey, Eghosa, we saw this thing about Flutterwave. I said, oh, okay. I was like, what do you think? I was like, you read the same thing I read. And then she was like, so should we be concerned? And for those of you who've never sort of operated in the US, especially sort of New York and whatever it is, there are these sentences that get delivered that are coded. So when someone goes, should we be concerned? They're not asking you for permission to be concerned. They're telling you that they're concerned, and they want you to tell them why they shouldn't be. But what was fascinating was I got to that dinner very randomly. I wasn't even planning to be I was 50-50 whether I wanted to go, and then decided to go. So I'm just curious, because I'm thinking, so how many of these conversations are happening in rooms that we have no access to, or we're not in, where people who have a ton of experience, people who have a ton of influence, are having these conversations and are concerned because they're like, we don't really see anybody talking about these things, and we don't see anybody pushing back on these things, and we don't see anybody complaining about these things. All we see is a whole bunch of people that seem to be endorsing these things through silence. And before you know it, someone's like, oh, there's no more money coming in. And you're like, yeah, because some random person who sits in some gigantic financial services institution made a comment. They said, oh, we don't know what's going on. I know, by the way, they seem to be doing their own thing. They're probably not the place to go. Let's go double down on China. Let's go do Latin America. These are the things that you fight that are not necessarily visible to people.
Sure. I think it's very clear. And again, I know there's a lot of people in the room that if you want to raise questions or comments, it's just drop a note or raise your hand. But because to my reaction, I think my initial reaction to the Flutterwave story, again, allegations, but the story was that this would kind of set back the ecosystem 2 years or so. And who am I to speak about the ecosystem, to judge the ecosystem anyway? But it did feel like, it's so, things are fragile, right? And and there's perception is everything. So people on the outside still look at Africa with probably question marks, and then a lot of people spend a lot of time sort of celebrating early success stories, also simply to showcase all the good things that are possible, and then things that are things like the follow-up story, then kind of it takes us back a couple of steps. At least that's what it feels like to me.
So the big issue, I think, is, and I mentioned this in one of the groups. I was like, look, we need more African champions, right? Because we have a huge dependency, with so few of them, right? And so when one or two fall, especially because they're so high profile, right, it feels like the whole place is falling apart. So there's that, right? The other thing I think is that in classic crisis, responsive PR, crisis PR, whatever it is, right? Everybody knows that, so let me give you a classic example. You probably watched the program 48 Hours, right? Where, homicide detectives always tell you, it's just a thing that your best chances of solving a homicide lie in the first 48 hours. And then everything else just sort of declines, your probabilities sort of get much lower. I think that's the same thing with crisis PR, right? You got 48 hours, right? And even if it means you some bland statement or whatever it is, but there's a gap there, and bad news travels very fast. Good news, bad news has traveled around twice around the world by the time the truth has gone halfway, right? And one of the things about the African champions that I feel has got lost is that you're standing on the shoulders of a lot of people that are invisible, right? And so I think once you identify as an African champion, you have a much greater obligation to protect the ecosystem and the perceptions of the ecosystem. So when there's a crisis like this, you need to swing into action quicker than maybe most and fill this gap before it starts to really become corrosive or implodes like a black star. And we didn't see that happen, right? And it took a week plus to be able to get some responsive statements and this and that, and there's all of this. And I don't, like I said, and I said this sort of thing, it's not really even about Flutterwave, because that's going to end up where it needs to end up. They're going to do the investigations. No one even knows where the truth starts and where it doesn't. But it's more important to sort of take the lessons of that and sort of the other things. We also had last year the sexual harassment issues with Tizeti and a whole bunch of things. So it's not the good thing is, from a numbers perspective, they are smaller, percentage-wise, it's not indicative of sort of a complete malaise in the ecosystem. But when you have the higher profile folks, when it's happening to them and they're not necessarily behaving like they care about the damage to the ecosystem, right? Like this dinner I was at, right? You would never, if I hadn't been there, I would never have known these conversations were being had. I would never have known that someone was looking at that particular story, investigated or not, verified or not, validated or not, and saying, do I walk away from this market? Right? You just don't see that. And all these money folks, they talk to each other all the time behind the scenes. And so I think, at the end of the day, what we have to do, right, is, and it goes back to the point I made at the beginning, that you've always had, in my view, always had two states of character, right, and integrity. You have it at rest, where maybe the quote for it is virtue signaling, where people spend a lot of time talking on Twitter about things, the things they hope they are, they wish for, and so on and so forth. But that's one state, right? It doesn't really matter as much. The real state for character and integrity is when it's emotion, right? When you are making decisions about things that, you have to ask yourself, does this work or does this not? Is it a, whiteboard in a courtroom, right? Are you going to be able to defend that in an open courtroom saying, here are your actions, here are your statements, right? Or not, right? And that's why even as investors, we always ask ourselves this analysis, about founders. Who's this founder when no one's looking?
Sure. I mean, I guess one of my questions also with, and this is not a conversation about Flutterwave, but was that the list of allegations was so long, and that it felt like this is, how many people knew about this? How many people were, wondering? I mean, if you mistreat employee stock option scheme, right? I mean, it takes a bunch of people to get that organized and done and executed. So
I don't know if it takes that. I don't know if it takes that many, right? I think what you also have to ask yourself, which I think, I've said this before, and I absolutely take responsibility for the naivete that I displayed, right? If you've known these markets, particularly in Nigeria, right, the bad behavior, the bad work cultures, corrosive work cultures, predatory work cultures, this happens in almost every sector. Financial services, in banks. Are you kidding? Like,
sure.
Are you like, there's stories for days, right? But what I think, where I went off the reservation from a naivety perspective was thinking, well, we would have a new way to build a different kind of work culture, startups and so on and so forth. But what has turned out, which is really tragic, is that you find, so it's a repetition of what was old, right? And then going back to the virtue signaling, you find people sort of complaining about the old, but then becoming the people they complain about, right? And when you're also thinking about, well, how could people have nodded and let this go and so on and so forth, you'll be very surprised, right? In Nigeria, you've gotten to a point where, people just get confident about institutionalization of, say, corruption. They just get confident. I mean, it's not just Nigeria thing, it happens in Kenya and whatever it is. But, so all of a sudden the thing you do, right, is you'll be like, oh, that's normal. So again, the real question is, what is the definition of normal, right? And and you question it. And what I don't like is even us who have sort of been in the market, who are African or of African descent, then everybody assumes that, oh, that's the way you do it, so you should be part of that group as well. And I'm like, what makes you think that? But then they're like, oh, you're a disappointment because you're not in the game, you're not doing the game. Like I said, it goes back to the thing, we need more champions. And we need more champions that are built on character, we're built on integrity, that prioritize work culture. The good thing is that they exist. The bad thing is that the CEOs don't chase PR. That's the sad part. They exist. It's some fantastic founders, African founders, just absolutely fantastic. Some we've invested in, many we haven't. But we're like, but they're not playing the PR game. But there's a gap here that we have that I tell a few of them, it's time to. I'm sorry, it's time to, because we got problems. We got to vacuum it.
Yeah. Okay, I'm gonna. I think I have two more. This was about. I guess it's also about sort of. Yeah, it's about PR and making noise and about I don't know, maybe just just maybe not fake it till you make it, but there's also something here about things in the ecosystem that are people jumping on the bandwagon and celebrating someone else's success maybe without thinking things through properly, I guess.
Yeah, I mean, so Bill, who I've known for years, right, sends out a thread about how, the 13 years of this bull market run, right, has sort of made people, they've sort of built all these observations and learnings, I guess, about valuations and this and that. If we were paying 100x, 300x, 1,000x forward, right? I mean, we're finding companies that were being valued at $1 billion with $1 million in revenue, right? And so he was like, look, there's going to be some violent unlearning that's going to happen, right? And, you know, you're going to now need to sort of rethink how you think about valuations and this and that. And, you know, Bill has been through the progressions, right? He's been in up markets, down markets. He's a fantastic investor. I mean, you just, you know, he's a billionaire. There's a reason why. And he's a billionaire on carry, which you always like to remind some of these younger investors. It's not about you getting to a unicorn, your portfolio company getting to a unicorn. Someone has made so much money that in a partnership, his carry distributions have made him a billionaire. So calm down. Okay, when you're sitting there and talking back. But the bigger point here is, even for some of the investors who are talking about, who were like, look, this market is too frothy, you know, these valuations are indefensible and this and that. You know, you started saying things like that, which is the point here about, to those who were talking about the emperor having no clothes, we're getting excoriated, right? Because they're like, oh, you're a spoil sport, and so on and so forth. And so I make up this, you know, it's a play on Warren Buffett, right? But this was Warren Buffett, right? So which was bull markets make experts of many, right? But that is actually true. Everybody now starts to think they're great investors, right? Founders now start to think, oh yeah, no problem. I can go out and raise a seed round at $30 million, you know, a $30 million valuation with almost no traction, right? Because I can go and get a Series A investor who would do at 100, right? Investors were like, oh, the good old days, you know, you did a seed and, you know, your valuation, your entry valuation of the seed to the Series A was maybe 2x. And people got really excited and they were like, oh, it has to be 5x or 6x. So there was just a lot of excitement, right? And everybody sort of was like, oh, we're great investors. And I'm thinking, no, you're not, right? You're literally not, right? And then so there's something in there that I also pasted about Daniel Kahneman, who talks about, you know, there is, you kind of measure yourself over 5 years. That's sort of a good timeline. So I think a lot of it is people forgot how difficult it is to build enduring companies. People forgot how difficult it is to invest in companies that become enduring companies, right? And a lot of the old rules go through now. Everybody was excited, the SPACs came, then crypto came, and this and that. But it still ends up, you know, what I would say, it's always full circle. You know, a few things, you know, nips and tucks there. But, you know, all the people that made fun of Warren Buffett, all the people that made fun of him, right, when it was like slow and steady, you know, I'm not playing your game. I'm playing this game. And, you know, this game I know. And, you know, I'm not going to have FOMO, fear of missing out, whatever it is. I just do my thing. I think it's also important even for our audience, right?
Sure.
You find the best founders. You find those, you know, that can sort of create long-term value. You know, you decide whether or not you want to be an investor or a trader, right? There's nothing wrong. If you want to trade, you get in, you know, after 1 year, 2 years, if you can get a secondary, you sell out, fine, right? But be clear about who you are. Don't pretend you're somebody else, right? Sure. And then for the founders, a lot of this stuff is, you know, many of these founders have never hit a wall, like a macro wall. They don't know what that looks like, right? But many of them are going to be completely ill-equipped. And many of the investors are going to be completely ill-equipped to deal with that. And so, you know, founders are confused. I sent something out about how, wait a minute, 1 minute, you're telling me step on the gas and spend all this money and grow. Next minute, you're like, you know, you're giving me all these letters like EBITDA and FCF, free cash flow. And, you know, and I'm like, what do these letters mean? Because they never meant anything until they did. And I'm like, welcome to venture, right? So sure. a lot of what this is, I think, is just making sure that you know everybody's excited now. You know, oh, they're going to get into YC. Well, let me jump on this thing before they get into YC. I think YC is going to be a guarantee of success. It improves your odds, but it doesn't guarantee you anything. All it does is it improves your odds of access to a bigger network and more capital. But it doesn't guarantee anything, right?
So, I mean, this is very much about sort of also, I guess, about in a way humbleness and understanding that, you know, I mean, there's a sort of instant gratification or expectation that, you know, my crypto will skyrocket automatically because that's what they do, kind of, right? I mean, you know, I invest in startups because they will succeed, etc. Right? So
yeah,
there's something there about humbleness.
But everybody has forgotten, right? I mean,
sure.
Here's the truth of the matter, right? At the end of the day, especially in venture, right? The power law has still not been undermined, right? There's always going to be one company that literally outperforms everything else you have done in your life, right? That's it. So when you're looking at angels, you're sitting there and going, look, sometimes what you just do is you find that one company and you hold them for dear life, right? And it may turn out that it may take 8 years or 9 years or 10 years instead of the 2 or 3 that you thought your friends were getting 3x, 5x, whatever it is. But that your 8 years or 10 years may become 100x. And so, you know, but it is about, you're absolutely right. The humility is just missing. People just got so cocky and so confident. And then, you know, I think Bill's point here was true, which is it's a 13-year bull run, right? So there are people who've been investing 13 years that have never seen a down market because they will have missed the global financial crisis in 2008. They will have missed that, right? So, you know, if you had been in that market, because I was, I mean, I have never forgotten it. So again, it's all about, you know, you ride, you're excited because these markets are bigger, right? It's not, you know, the truth is these markets are bigger, the opportunities are bigger. I talked about this stuff. There's multiple compression, but there's not opportunity compression. So, you know, especially in Africa. So the markets are bigger, they're underserved or completely, in many cases, grossly, you know, unserved. But let's not be too excitable.
Sure.
Right.
And I'm very conscious of the time. We only have a few minutes left, and let's not discuss that now. But you did make me think when you commented on the sort of, you know, investor versus trader. Not right now, but when you put it in a tweet, because I do think that a lot of sort of the current sort of investor syndicates, you know, maybe also angel investor syndicates, right? Most of the angel investors are not in it for 20 years or 10 years or maybe 5 years, right? And a lot of these syndicates also right now are, you know, the business model is mere, you know, unrespectfully more like a flipping model, right? Where you're in it for a couple of years. And obviously that's a different mindset and a different risk approach, et cetera, than the more traditional investing or VC investing. But I don't think it's necessarily wrong. It's just different. And like you said, you mentioned it right now. It's simply a different way of approaching it.
But you have to be ready for the regrets. I mean, if you want to flip, you flip, right? So I give you a classic example. There is a company I know that certain investors were just willing to leave at 200 million, right? They were just willing to be gone, right? Great. And, you know, they came in at 18. So at 200 is a fantastic return, right? Okay. 2 years later, it's 10 billion. Like I said, you have to be ready to deal with the regrets.
Yes, no, yes. But I think also that's a great article by, I think it was the Sequoia by a gentleman about, you know, investing is a lot of dealing with, is learning how to deal with regret. I think I have, I'm going to skip this one and I'm going to skip this one out of time. I'm sorry, I was one. So this is because I wanted to end the conversation with this one because this, I wanted to sort of bring it back to the conversation about ethics and values and you know, some of the things that people should think about in terms of actually being able to manage processes and go about managing conflict, etc. And here you already sort of mentioned a number of things that you know, that are relevant for that conversation. So maybe you kind of can walk us through this really quick in terms of, you know, what this means.
So I think first of all, this governance training part is super important, right? We talked a little bit about, you have a lot of founders in the market that are running companies, but they've never even run, business units, right? They've never even run divisions, right? So you have this very interesting, they've got great product instincts. They can do partnerships, but at the end of the day, just even understanding what it means to be a founder, CEO, founder, COO, how to manage people, how to manage processes, how to be good directors. I did a training many years ago. I got to go find it because I updated it a few years ago. I got to go back and find it because, that is going to be very important. Right. The other thing about processes, so because this goes into governance, I've made this point before about ESG, that, especially in the emerging markets, everybody talks about ESG, but, it feels like everybody talked about the E and the S, but forgot the G. Right. And so how do you sort of reestablish and re-implement the G? That's going to be very, very important. The other thing I talk about here is this whistleblower policy thing. And, it's always an interesting challenge because if you worked in a big company like I did, right, you always ask yourself, who does HR report to? You're like, HR reports to the CEO. You're like, wait a minute, how does that work, right? And one of the things that we did when I was at Intel, which was fascinating, was that the head of internal audit, who does the internal investigations, right, reported to the CFO, but also reported to an independent director, right? So you always had that sort of two-way process where,
sure,
you wouldn't sort of, you wouldn't risk retaliation. And I think that's why people don't talk, right? You talked a little bit about how so many people have known. Well, who are they going to talk to? Sure. Who are they going to complain to, right? You go to a journalist, I don't want to destroy the company, but how do I sort of course correct it? And then you're like, where are the independent board members, which again goes back to this. So fundamentally, we're talking about the board members and the board representation, like we're having a board, and convincing these founders that the board is not a retardant to your product or execution acceleration, but also having folks who can have a 360 view, right? And we've seen it in some of our companies, the value of having an independent director who's not necessarily an investor, who's not a shareholder, right? But can come in there and bring those insights and the like to be able to say, hey guys, you can't do this, and you can't do that. And so, I know, this is all sort of non-public, but I know there's some vicious infighting going on in a bunch of startups now because of things, on this page. And so hopefully that comes out to be good. But these are just a few examples of
sure.
the course correction that needs to happen. And the earlier we do that, the better.
Very good, thank you. So we're really running out of time. So I wanted to sort of end this conversation with more of a conversation also with the group in terms of specifically on a more angel network level in terms of things that you could do in this respect. So a code of conduct is what most people already have, industry associations, obviously be trained, etc. I think we have.
There's one more thing. Yeah, I mean, this is fantastic. I love this because it's a good way. No, that's one, right? So I think this is a good way to sort of say, how do you build character and emotion, right? And it's kind of important, right? But at the end of the day, we're all going to be judged by the things we do and the things we don't do, right? So it's also kind of important that even the number 7 thing is, disavow willful blindness, right? Sure. The stuff that you pretend you're not seeing even though you see it, because hey, I don't want to spoil the show, but
sure,
there's some big companies that are going to get built in our ecosystem. Very large, they're getting built. Very large companies. They will probably be even bigger than most of the U.S. companies we talk about. So we have a shot at it, but we've got to make sure that we don't ruin it before these companies become who they can become.
Thank you, Eghosa. It feels almost rushed, this ending of the session, but I'm going to thank you again for joining us this evening and for sharing all your wisdom. Also, of course, to the group, thank you for joining and joining us today. The slides that we shared with you, I think we had one more slide here on, this is simply for not for you, Eghosa, but for the participants of the program. So we have the showcases coming up. Ayanda, is there anything you wanted to specifically mention about the showcases?
Not necessarily, no. Please just RSVP to the country that you would like to join. They're happening in the next 2 weeks. And the DRC showcase will be happening obviously in French because the language of business is French. So that's 2 notes there. But the Angolan showcase will be happening in English, but please do, the RSVP link will be sent through to you. So use the Eventbrite and share the Eventbrite to other angels who would also like to attend.
Great. So thank you so much. Sorry for running a few minutes late, but we have Eghosa. So I mean, I think maybe that justifies it. If you want to know more, I would very much advise everyone to follow Eghosa on Twitter if you like this conversation and you wanna hear more or reach out to Eghosa directly. So apologies again for running a few minutes late. Thank you all for joining, and Eghosa, thanks again for being with us this evening. And everyone will talk soon again.
David,
okay?
very quick question. I know people are asking the replay. Do people get to watch this or listen to this?
Ayanda, what do we do with the recording here? How is it made available?
I will share it in an email tomorrow.
Okay.
Okay. There we go.
All right.
Cool.
Appreciate it.
Okay.
This was great. Thank you very much to everybody.
Thanks, everyone.
Thanks to everybody that listened. Really appreciate it.
Thanks, Eghosa. Thanks, everyone.
Right.
Thank you for joining. Thank you.
Thank you. Bye.